Hello everybody and welcome back to another episode. Crocs stock has went down big from when I first invested in it. I bought my 300 shares at $114 a share and today it trades right at a $100 bill. And this company just reported earnings and this is the big reason for their drop. You can see if I expand the chart right here, if I look over the last 1 year, their big drop came just the other day right here when they dropped over 15% just off of the back of their earnings. Now we're going to go over today what happened in those earnings. We're going to go through this 40-page investor presentation that Crocs went over, but we're only going to give the ones that I find most important. We're not going to go through the whole 40. We're only going to give the things that I find most important. So if you're interested in Crocs or you want to invest in it, this is the video for you. It's my largest position. If I hop over here to my holdings position, as of the last time I've updated this, this is 47% of my invested net worth. So pretty much half. And this is a company that makes a big performance rating on how I do against the market, whether or not I'm beating it, going against it, and as of today's August 11th performance, I have come down quite a bit in August, having a pretty bad performance. We are still beating the market, but I'm reverting a lot back to the mean, and a lot of it is because of these Crocs earnings. So without further ado, let's go ahead and jump into Crocs, and if you haven't checked out already, I have a mentoring session opportunity down below in the description. Please check it out if you haven't already. I highly recommend this for new investors right here. This is my contact information and getting started with me, so check this out down below if you're interested. But without further ado, let's go ahead and start with Crocs. Now this is a company that is getting more profitable, and one of the main reasons why this company dropped is because of the performance of Hey Dude, which we'll be going over in depth in just a second. But generally speaking, gross margins are heading in the right direction. Year over year, quarter two last year versus this year is going in the right direction when you look at Crocs and Crocs Incorporated, but Hey Dude was flat. I would like to see this go up at least a little bit. Flat is not good, but the good news is Crocs brand itself is going up anywhere between 4 and 3% for Crocs and Crocs Incorporated. Now that's good, and not only is the gross margins heading in the right direction, but the company is growing faster than they expected just 90 days ago. If you look at the total revenue growth, they were previously expecting 11 to 14% with a midpoint of 12.5%. So they're saying, hey, this year, 2023, we're going to grow about 12.5%. Now they're projecting a midpoint of 13.5%, so they're projecting faster growth than they were just 90 days ago, and a lot of this is coming from Crocs, because Crocs itself was expecting to grow around 8%, now they're expecting 12.5%. The big downturn here, and the big reason why this company sold off is because of the revenue growth projected for Hey Dude, which I have to admit, this is the one big negative for this company that I did not see coming. They were expecting mid-20s, so let's call it 25% revenue growth, and now they're saying they're only going to grow 16% reported this year. That is not good. They did highlight some issues on the earnings call with Amazon sellers and some other reasons, but I don't really care what the reasons is. Going from a 25% to a 16% growth rate is a pretty big downturn, and I am not happy with that. The good news is, overall, due to these big beats with the main Crocs brand, it beat so much, so high, that it actually lifted up the entire guidance with it. And speaking of the guidance, let's go ahead and look at the margins and the earnings per share projections. Now, not only are they projected to have more revenue this year, but profitability is expected to come in a little higher. The operating margin was expected to come in at 26.5, now it's expected to come in at 27.5, so plus 1% margins expected the rest of this year. Earnings per share expected to do the same thing. You see it, they project 11.17 to 11.73. So just rough paper napkin math here. You can see it, they're projecting around $11.50, and now their midpoint is around $12. So let's go ahead and highlight these bullet points right here. Margins for Crocs are heading in the right directions. Hey Dude, it is flat. Now, it's not only margins, but revenue growth is doing the exact same thing as well. Crocs is beating on top line and bottom line, and Hey Dude is not. So it's a pro and a con, however you want to see this. Crocs is the bigger portion of the company, so it's lifting it up, but their big high growth brand that they spent $2 billion on is not performing the way that we thought it would this quarter. Now with this profitability, they are deleveraging big time. And rather than show this highlight for this company's deleveraging, I'd rather just go ahead and pull it up on Qualtrim here, the balance sheet over time. Now let's go ahead and look at the cash. When this company initially took on the acquisition just a little over a year ago, they had around $170 million in cash. They have right around the exact same amount, so they're pretty much flat year over year in terms of cash balance, but their debt, which is the money they took out for buying that new company, Hey Dude, is dropping rapidly. When I initially bought this company about a year ago, this company had lots of debt. They had about $2.8 billion in debt on their balance sheet, and this is not capital leases, just to be clear here. This is not rent escalations or leasing out buildings. This is the nasty debt, the stuff that can bankrupt you if you're not being careful, if you're not being wise with your money, if you're not being good stewards. So with 2.8 billion, that's pretty risky for a company of this size, and the 2.8 billion has dropped all the way this quarter to 1.95. They have paid over $850 million of long-term debt off in just 5 quarters. So that's pretty nice there. And because they're deleveraging, this company is finally repurchasing shares again. They resumed them in July of 2023 this year, so last month, and their long-term target is to deleverage the company more. So I do expect this long-term debt number. Right now, they currently sit, like I said, around 1.95 billion. I expect this to probably go around 1.5 or so billion over the next year or two. But more importantly, as they're paying off debt, which makes this company more profitable and less risky, they're going to start buying back shares, which they started last month. So you see that they were buying back shares consistently over the last decade, lowering millions of shares every single year until they had that acquisition right around here. Once they got up to this 62 million share mark, they've been either flat, if not slightly increasing quarter after quarter. Now they're going to start buying back shares, and I would expect this 62 million to go down to 61, 60, 59, 58 million, especially since the company is so darn cheap. Now, speaking of cheap, the company is trading at a forward PE at around an 8 right now, which is dirt cheap considering the circumstances that this company is still growing, in my opinion. Now, keep in mind, this is a rubber shoe company. Investor headwinds and honestly just the way that people shop for brands and clothing and clothing trends in general can change on a dime. But that said, a $6 billion market cap for a company that's now doing over $1 billion in revenue every quarter, in my opinion, I think it's doing pretty fine. And most of this growth is coming from the Asia Pacific region. Now, I have mentioned this before, and I'm not going to spend too long on it, but I want you to spend some time researching the international part of Crocs, because if you're wanting to invest in this company, I don't think your investing thesis should be behind Crocs North America. Now, right now, that's where around 7/10 of their revenue comes from, 69% to be exact, but I think that this is not the big growth driver. These 15 and 16% categories, especially this one right here in orange, is the big winner gonna be for this company over the next couple of years, in my opinion. Now, they're talking about revenues for this company growing 30% CAGR, so not 30% versus last year, 30% compounded over the last 2 years, and they're projecting big growth this year. You can see that quarter 2, 2023, the trailing 12 months is up 47% versus fiscal year 2022. The Asia Pacific region is going up big. Now, I mentioned this before, and I think that if I look at this, let's go ahead and pull up worldwide first. This is from 2020 all the way to today in 2023. You can see the big peaks and troughs here. This is every search trend on Google. Now, right around this time, July, August of last year, we were around 75, 80 or so, and now we're near all-time highs, 90 to 100. Now, there's a couple countries in particular, mainly China and India that I'm looking at, and China is one that I can't really find search results because they don't use Google there, so we can only really see India, but India specifically is exploding. July, August of last year, they were around 60, 65. Now, once again, we're around 90 to 100. This is very good for a very, very populated, close quarter country like India, and I think this is really going to benefit this company as they get revenue from other countries. And I showed this before, and I'm not going to do it again, but I would highly recommend. These are the top 15 in order, the top 15 countries by GDP, the most money and most powerful economies out there in the world. I would recommend looking up every single one of these and see what the Crocs search results look like. I think you're going to be pretty shocked if you look over a couple year basis and you search these different countries on Google Trends. You'll be shocked how good this company is clicking on all cylinders overseas. While the United States is kind of it's okay, it's not doing that great, I think it's really interesting to see how big this company is doing overseas. Now, one more thing I'll mention and I'll close out with is that this company is currently getting revenues overseas at a time when the dollar is becoming more valuable. If you look at the last 3 years, which by the way, I just realized I said dollar more valuable. I should flip that. The dollar is becoming weaker. Ever since it was skyrocketing over the last year or two, overseas revenues were becoming less and less valuable. Well, over the last 9 or 10 months, you can see that the dollar value has slowly dropped versus a lot of the other world currencies. And this is making overseas revenues more valuable, which means if you're growing at, say, 10%, but the dollar is dropping, you might start growing 12% or 13% or whatever the number may be. Now, this is just a small little piece of news here. This is the cherry on top. This is not a major investing thesis, but it is helping a company like Crocs, who is currently getting a lot of their growth overseas. But generally speaking, when I look at this earnings report, I don't see a lot wrong with it. The one thing that I really don't like and why investors dropped this company so much was because of the Hey Dude company not growing the way they thought it would. Okay, I get that. But that said, as of right now, this company still has about 3/4 of their revenue coming from the Crocs brand. So Hey Dude is a small acquisition that is more of a separate line item that definitely matters. I'm not saying it doesn't, but the overall revenue growth and the overall margins and profitability and all that good stuff is where you should really be focusing on. And when I look at this, I see a company that is raising their revenue growth, that is raising their overall operating margins, and raising their overall diluted earnings per share. That said, the company is going to start buying back shares now, today, right now at these super low prices. So not only does this company get to buy back shares, but they don't have to buy the shares back where they were just the other day at 120, 130, even as high as 150 just a couple months ago. Now they get to buy back these shares at right at a $100 bill at today's closing price. So this is why I own Crocs. This is why I'm invested in them. Leave your questions down below and check out what I'm highlighting right here, the new mentoring sessions I'm offering again that I used to do over the last couple of years. Thank you guys so much for watching, and I'll catch you all next time.